Payal and I am from the Management Study Guides content team. In this course, we will learn about Introduction to Financial Management. So, let's get started. You know that the primary objective or goal of any business is to make profits. Also, each and every business always deals in large amounts of money. Hence, you can understand that finance and financial management play a crucial role in the successful and smooth functioning of any business. Also, when financial management is ignored and not closely scrutinized, it can lead to extremely damaging consequences for an organization. Let us understand this by looking at how a successful company saw its downfall due to its poor financial management practice and understand what happens when good financial management norms are not followed. Thornton Inc. was an American oil and natural gas company based in California. It was formed by Keith Walker after several years of experience in the field of oil, natural gas, and energy. Thornton Inc. grew into a giant business in just 15 years to become America's 7th largest company. However, in reality, the firm's success turned out to have involved an elaborate scam. Thornton Inc. became the synonym of the word scandal when its large-scale scandal shook the corporate world. Thornton's scandal came to light in November 2003. Thornton was involved in the use of accounting loopholes, special-purpose entities, and poor financial reporting, and was able to hide billions of dollars in debt from failed deals and projects. Thornton had also lied about its profits and was accused of a range of shady dealings, including concealing debts so they didn't show up in the company's accounts. Thornton was forced to file bankruptcy under the Chapter 11 bankruptcy in December as the depth of the deception unfolded, and the investors and creditors retreated. The Thornton incident made everyone realize the importance of good financial management for a company and forced everyone to question the existing financial management practices in several organizations. The doctored accounts which flouted all the established norms of the accountancy practices, false financial statements, and the Thornton executives who pocketed millions of dollars by selling their share of stocks while laying off the 20% of the organization's workforce, painted a grim picture for the financial management scenario and investors. Also, it was a real shock to financial experts across the globe that external agencies like auditors, credit rating agencies, and security analysts had failed to identify the scam and had failed to see the real picture. Hence, you can understand that good financial management practices and a close scrutiny of the financial management practices in an organization can prove to be the difference between success and failure for any business. The financial management practices of a company can also have a large impact on the shareholders, society, as well as the employees of the company. Let us now learn about the Introduction to Financial Management in detail. By the end of the course, participants will be able to explain what is financial management. They will be able to list the objectives of financial management. This program will explain the various elements of financial management. It will also explain what is capital structure and what is capitalization. This program will help you describe the important long-term sources of finance and the important short-term sources of finance. You will be able to list the objectives of financial planning. This program will help you explain what are financial statements. It will also explain the various important financial statements and list the categories of financial ratios. We will also explain the various types of leverages. Describe the role of a financial manager. Describe the role of reporting in financial management. and will help you describe use of chart of accounts in financial management. Did you know? The following are the main legal forms of business. Number 1. Sole proprietorship. A business owned by a single individual. The owner maintains title to the firm's assets. Number 2. Partnership. Partnership is similar to a sole proprietorship except that there are 2 or more owners. Number 3. Limited liability company. This is a cross between a partnership and a corporation. Owners have limited liability, but the firm runs and is taxed like a partnership. Number 4. Corporation. A business entity that legally functions separate and apart from its owners. Owner's liability is limited to the amount of their investment in the firm. Some of the important short-term sources of finance are short-term loans from financial institutions, commercial paper, factoring, accrued expenses and deferred income, trade credit, mutual funds. Let's understand each of these in detail. Let me give you a tip. You can buy preference shares, which would give you the following benefits. Number 1, tax advantaged investment income. Number 2, security of principal. Number 3, priority of dividends. And number 4, exchange traded markets. Functions of financial management. The following are the key functions of financial management. Number 1, estimation of capital requirements. Number 2, determination of capital composition. Number 3, choice of sources of funds. Number 4, investment of funds. Number 5, disposal of surplus. Number 6, management of cash. Number 7, financial controls. Let us understand each of these functions of financial management in detail. Let us understand what is the importance of financial planning. Financial planning is a process of framing objectives, policies, procedures, programs, and budgets regarding the financial activities of a concern. This ensures effective and adequate financial and investment policies. The importance of financial planning is as follows. Number 1. Financial planning helps in ensuring a reasonable balance between outflow and inflow of funds so that stability is maintained. Number 2. Adequate funds have to be ensured. Number 3. Financial planning ensures that the suppliers of funds are easily investing in companies which exercise financial planning. Do you think there are some limitations of financial statements? Let's try understanding. They are not final statements. They do not record many events. They do not show true financial condition, and they account for past than for future. So there are basically 3 types of leverages. The first one is operating leverage, OL, which is equity. Second one, financial leverage, FL, debts and loans. Thirdly, combined leverage, CL, operating and financial. Let us understand the role of finance function in organizational processes. Contemporary organizations need to practice cost control if they want to survive the recessionary times. Given the fact that many top-tier companies are currently stuck with low growth and less activity situations, it is imperative that they control their costs as much as possible. This can happen only when the finance function in these companies is diligent and has a hawk eye towards the costs being incurred. The following are the main functions of a financial manager. Number 1, raising of funds. Number 2, allocation of funds. Number 3, profit planning. Number 4, understanding capital markets. Now, let us take a look at each of these in detail.